All right, we are officially off to the races. Carmen Holdings celebrating the opening bell here at the stock exchange after its NYSE debut as a publicly traded company yesterday. That stock surging more than 30% in its market debut and raising $500 million in the actual offering. We want to talk more about the markets, of course, as this Valentine's Day trade gets underway. And joining me now with more is Doug Cohen. He's a portfolio manager at Fiduciary Trust International. Doug, it's great to have you on the show and a lot to digest. Certainly for traders and investors this week, it has been choppy, but it looks like we'll end the week on a higher note. What do we need to know?
Well, I think you need to know this week that we got inflation data that spooked the markets a little bit. But that kind of monthly data comes, it goes. And one of the things I've always been fascinated by is my view that the market tends to over-exaggerate one data point and not really realize that, it takes several points to make a line. And so I didn't lose a whole lot of sleep about, especially a January inflation print where we get some sort of beginning of the year anomalies. I still think we're going to be on a course where inflation is going to be relatively steady this year. Maybe not quite as good as the Fed would like, but not too bad either.
Mm-hmm. Well, there has been a lot to digest between a testimony, of course, across 2 days from the Fed Chair Jerome Powell, 2 inflation reports, and the retail sales data this morning, not to mention tariffs that the White House has enacted and that are potentially on the way as well. How does this set the scene for the rest of February, historically a volatile month?
Oh, I think it sets the stage for the rest of February, and I think it sets the stage for the rest of the year and maybe the rest of the next 4 years, because we're going to get a lot of headlines that relate to policy. You mentioned tariffs, and that's certainly one of the major questions that we get from clients all the time now. Look, there's a reason that some of these uncertainty indices are as high as they are. We all know what's coming out of Washington, D.C., or actually we don't know what's coming out of Washington, D.C. It's sort of a flurry of things. However, I do think it's important to note that over time, the bark is usually worse than the bite on some of these things. I don't mean to minimize the potential risks because I think there are a lot of things that can happen. But my personal view is that President Trump does pay attention to the markets, that a lot of these proposals are essentially negotiations. Doesn't mean they're all going to work perfectly, but I think for the most part, the impact is going to be less than people fear.
Mm-hmm. What are the sectors that look to benefit in this environment, Doug?
Yeah. So look, I'll give you a broad statement first, and then I'll give you a couple of sector ideas. I think first, from a valuation perspective, my view over a long period of time has been that valuation means next to nothing in the short term. However, it does mean a lot in the longer term in terms of framing reward and risk. And to me, one of the biggest anomalies out there today is healthcare, which has really been under pressure over the last several years, has underperformed significantly. The little statistic for you would be that healthcare normally trades at about a 5% discount to the S&P 500. It ended last year at about a 20% discount. So my favorite sector over the course of the year, just from a pure risk-reward perspective, is healthcare. I think you're going to see more M&A, particularly in that sector. And I think that Trump ultimately is a populist. And again, while there'll be some headlines that are maybe disconcerting to some folks, ultimately, he is not going to want to do anything that diminishes people's access to vaccines, to drugs, to reasonably affordable insurance. So I don't expect any draconian reforms to really rattle the healthcare sector, and I think there's good value there.
Does the economy look like it's holding up to you, Doug?
It does. There are a lot of positive signs. I wouldn't say it's quite Goldilocks because I think the inflation issue is one we are going to have to address. And again, this uncertainty that's been created, I didn't mean to minimize it before because I know that we're going to have a lot of fits and starts and just things that creep up. And I don't think that's necessarily ideal from a business confidence perspective. But again, on balance, I think the bark will be worse than the bite. And I think the policies will not be overly harmful to business. So I think we have a reasonably good economy on tap for 2025.
Carmen debuting yesterday here at the stock exchange, double-digit pop. We've seen some big IPOs out of the gate this year, including in the energy sector, as you mentioned, which is expected to benefit under this new administration. The fact that we're seeing more deals come to market, Doug, and pretty decent offerings in terms of market reception, what does that signal?
Well, I do think so. Every year I do a list of 10 surprises. And one of the surprises this year is that we really do see a surge in oil services stocks. I think part of that will be based on consolidation, but I think there will be some animal spirits in certain parts of the market. And M&A generally has been held down for the last couple of years via regulation from a very difficult FTC and DOJ. I suspect that's going to really change course here over the balance of this year. Again, I don't think it's going to be a rocket ship because I think some of those headlines will create some uncertainty, and that might put a little bit of an occasional damper on things. But on balance, I think you're going to see a lot of M&A, and I also think you're going to see a pretty robust IPO market, which, as you pointed out, we really haven't seen for the last few years.
Carmen here for that first trade bell, Doug. We'll wait to see that on the floor of the stock exchange. In terms of the fixed income market, that, of course, is a factor here as well. How does that look to you?
So fixed income looks better to us than it has in the past few years. Again, all these things relate to each other. I think the inflation outlook is clearly paramount. Our view is that inflation will be relatively benign this year. And I know, we're off to a little bit higher start than folks anticipated. But I think on balance, inflation will be relatively consistent. I think we'll see prices come down, particularly for housing over the latter half of the year and a little bit for wages as well. I think that's going to allow yields to kind of stay in a fairly tight range. And look, I think the equity market is objectively expensive. There's no question about that. And as I said earlier, I think valuation does matter in the long term. And so in that sense, I think you have to be a little bit cautious about equities broadly, and particularly some of the marquee Magnificent Seven type stocks that have led the market. And then fixed income thus becomes more interesting as a place to get a reasonable amount of yield without taking a tremendous amount of risk.
Doug Cohen, Managing Director and Portfolio Manager at Fiduciary Trust International. Doug, thank you.
Great to be with you. Thanks.